Pat, one of the biggest reasons why entrepreneurs fail is because they run out of cash. And oftentimes they don't know what happened. And so the question is, can we help entrepreneurs better understand their cash so that they don't get blindsided by cash flow issues? And so that's what we're going to talk about right now. So Pat, let's go ahead and share this spreadsheet and let's go through this exercise.
All right, so Simon, we are going to look at a little model called Inner City Assembly Company. And this is a very simple income and cash flow model, 6 months only, and very round numbers, not all that realistic, but the whole purpose is for demonstration so that it's easy to follow and easy to understand what we're doing. So we're going to go step by step and set up the income statement and then look at what's going on down at the bank, because as you said, we want to avoid that giant pitfall of running out of cash. So we're going to look at our numbers starting right here. Inner City is a little widget company. They make a little gadget that sells through distributors and is used in the automobile and in the home. So the market is vast potentially, and our entrepreneur is just getting started with very optimistic plans for where this company can go. So our income statement has revenue and expense. And under revenue, we're going to look at how many units he thinks he can ship each month. And this is our sales forecast. So we are going to talk to the distributors and see how much they think they can place each month. So in month 1, he's just getting set up, so no sales. Month 2, he has 2 distributors who will each commit to ordering 1,500 units. In month 3, he has the same 2 distributors, each ordering 3,500 units. In month 4, they're ordering 5,000 units each. In month 5, he finds another distributor who will order 4,000 units, and the first 2 will order 5,000 each. And in month 6, he has 4 distributors, each ordering 5,000 units. So our total revenue then, the units sell at $2 a piece. So total revenue for month 2 is twice the unit shipped, so $6,000, then $14,000, $20,000 in month 4, $28,000 in month 5, and $40,000 in month 6. Now we go down to expenses. We have materials that go into our gadget, our widget, and there are only 1 or 2 suppliers in the country who have this very specialized material. So our entrepreneur is pretty much going to have to go with their terms and do what they say. So materials, he's not using any. Now the income statement shows us how we use things up. So in month 2, we're using $3,000 worth, or 3,000 pieces of material to make 3,000 widgets. It's $1 per item. So 3,000, then 7,000. In month 4, 10,000. In month 5, $14,000 worth of materials. And in month 6, $20,000 worth of materials. Our entrepreneur outsources the actual assembly and putting into a little box of the widgets. So in month 1, no sales, so no direct labor. In month 2, and the little outsourced Busy Fingers Assembly Company charges 20 cents per unit. So in month 2, we have a cost for labor of $600, then $1,400, $2,000. In month 5, $2,800, and by month 6, $4,000 for Busy Fingers Assembly Company. And we have overhead in the next line. Now, overhead is often the electricity. It might go into manufacturing a product, but in the case of Inner City, a simple little company, overhead is Jimmy, the kid down the street who has a Jeep and is willing to haul those materials back and forth from Busy Fingers to Inner City. So in month 2, we pay Jimmy $100 a month. In month 3, $100, and in month 4, $100. But as sales grow, he has to make more trips up and down. So overhead goes up to $200 in month 5 and $200 again in month 6. And now we can look at a cost of goods sold. So that's the expenses directly related to the units we sold that month. So in month 2, we have $3,700 cost of goods sold. Month 3, $8,500. Month 4, $12,100. Month 5, $17,000. And month 6, $24,200 cost of goods sold. So we subtract that from our total revenue, and we can get our gross profit number. So gross profit in month 2 is $2,300. Month 3, $5,500. Then $7,900. Month 5, $11,000, and by month 6, $15,800 in gross profit. So that gives us a pretty strong gross profit margin of 39.35%. And those things vary by industry, so you can't really compare that to someone else unless you know something about the industry and what actually is considered a norm. But that's a pretty sound gross profit margin. But we're not done with expenses yet. There are some.
Pat, I was going to say that what you've just shown us is one of the first skills that an entrepreneur needs to learn is how to calculate the gross profit in their business, right? And so if you're thinking about your financial projections, an entrepreneur needs to understand how to calculate their gross profits. Now we have to enter some additional data to calculate the net profits. And so Pat, help us understand that.
All right, Simon. So the next expense here is salaries. Now, our entrepreneur knew he wasn't going to have any sales in month 1, so he decided to do without a salary in month 1. But in month 2, he starts to pay himself $2,500 each month. But in month 3, he realizes he can't do it all himself. He can't be out calling on distributors and in the office answering the phone and on the loading dock, loading trucks up with the outgoing materials. So in month 3, he has to hire some part-time help. And by month 4, sales are growing, so he hires additional part-time help. So salaries go up to $3,500 in month 3 and then $5,000 a month in months 4, 5, and 6. Now we're not calculating any sales, payroll taxes on this. It's just straight salaries. So your own spreadsheet would be a little more complicated, but we're trying to keep it simple here. So the next expense is rent. And you know that rent, he negotiated a little off the main road office and warehouse space. So you see these maybe on the outskirts of Garland, Texas, or off of Industrial Boulevard in Dallas. It's a little row of office space at the front and some warehouse and a loading dock in the back with a garage door, and trucks can pull up and you can ship. So instead of the usual paying rent by square foot per month, we are just paying per unit. So it's $800 for the unit he rents, and that stays the same for all 6 months. Our entrepreneur needs some basic business insurance. And so he buys a basic business insurance policy, and he pays $1,960 for a year, but he's using it at a rate of $160 a month. So again, the income statement is showing how you're using things up, and the insurance is used up at a rate of $160 every month. And then we have depreciation. On the income statement, you depreciate major items that you buy. So the entrepreneur needs some basic office equipment, desk, chair, computer, and he buys $6,000 worth of office equipment in month 1 and depreciates it at $100 a month. But by month 3, he adds part-time help, and so he needs another desk, chair, whatever, a couple more items. So depreciation goes up to $120 a month and continues through month 6. Then we have office supplies. And we're not going to amortize or depreciate that because that's a small amount relative to the other numbers on our chart. So he buys $120 worth of notepads, pencils, paper clips, those random things that you need, and expenses them in month one. And then we have advertising. We have to let the world know that InterCity's in business. So our entrepreneur locates a little one-man ad shop called Eon's Advertising. And Eon strikes a deal with our entrepreneur that he will start advertising, design ads, and place them in industry journals. And he will grow the advertising as sales grow at InterCity. So in month one, we have $400 for advertising. Then it grows to $600, then $1,000, then $1,400 in month four, $2,400 in month five, and $3,000 for advertising in month six. And our next expense is brochures. So our entrepreneur buys $600 worth of brochures and uses them up at a rate of $100 a month. He's out calling on these distributors and trying to get him interested in his widget and leaving brochures with them, not just for their use, but for them to pass out to retailers when they're trying to promote his product. So $100 a month for brochures. Now we have a total expense. We have $1,680 total expense in month one. Month two, $7,960. Month three, $14,180. Month four, $19,680. Month five, $25,580. And month six, $33,380 total expense.
Now, Pat, I'm looking at the expenses that you have here. This can't be all the expenses that a business has, right? Aren't there more?
There are usually more. And again, this is a very simple model to demonstrate our purpose here. You might have lots of other expenses depending on the complexity of your company.
So an entrepreneur really needs to understand what are the different categories of expenses involved in their business. Another very, very important skill.
That's right. You have to make sure that you understand what all it takes to start that business, or you're again going to underestimate the amount of money that it takes to get started. So let's go on down and look at our net profit numbers, Simon. We have some losses in the first 3 months, and that's normal. Most companies lose a little money at the beginning, but you want to watch that you turn the corner pretty quickly and start going in the other direction. You don't want to see numbers continually in the red, or you may need to do something to change your business model or just rethink the whole thing. So our entrepreneur has $1,680 of pre-tax losses in month one, and then $1,960 in month two, and $180 in month three, and that becomes the net profit or loss in this case. We have no taxes. This is a C Corp. Our entrepreneur decided to set up a C Corp, so he has corporate income tax. But the government can be brutal, but they don't charge you on losses. So you don't incur a tax liability until you have a cumulative positive amount. So we're going to go on, and you see that by month four, we're profitable. That's really promising because in month four, we have a positive number, but the cumulative number is still negative, so we don't incur any tax. Month five, $2,420 in profits. It's growing very nicely. And in month six, we have a cumulative positive. So our entrepreneur is going to owe income tax on the cumulative positive number, which would be the $4,709 6-month actual net profit that you see there. So we have then a net profit for month six of $5,789, and for the 6 months, $4,709 net profit. So pretty good. We've got a pretty strong net profit margin. And again, depending on industry, it can vary, but comparing to other similar kinds of companies, this is a pretty good profit.
And Pat, just to go back from a financial skills perspective, there's now gross profit, then there is pre-tax profit, and then there is net profit after tax. So as an entrepreneur, you need to understand these three different types of profits.
That's right. And what's more, if you start an LLC, you're not going to show income tax. You're not going to have corporate income tax. You're going to be personally liable for the tax on your profits. So depending on what kind of legal entity you set up, your spreadsheet might look a little different.
Well, great. So we've now been able to build a income statement, a very basic income statement from scratch. Now let's move on to the cash flow statement.
So Simon, I see you've brought the checkbook up into view. We call it the checkbook because we're looking at our cash just as you would your personal checkbook. When does money go in and when does money go out? And that's how you get the true picture of the cash in your business. If you add in things like depreciation or other kinds of line items that aren't really cash, it's going to muddle the idea. So in the checking account, we have receipts and disbursements. And under receipts, we have receipts from sales in line 1. And so in month 1, we had no sales. So we have 0 receipts from sales in month 1.
Oh, Pat, I'm sorry. I think I might have made a typo here because there is a 0 in month 2, but I know we made some sales in month 2.
Well, we did, Simon, but our distributors get terms of net 30 days. That's industry standard. And so we have no receipts from sales in month 2. And in month 3, we're assuming our distributors are really good guys that are going to pay on time. So in month 3, we have $6,000 receipts from the sales we made in month 2.
So Pat, that means that we literally don't get the cash till a month later.
That's right.
Wow. I think a lot of entrepreneurs don't really understand how that works. So this is a very important concept.
And this is assuming that they're going to pay on time. And we know that in reality, that might not happen with every distributor. So in month 4, we're going to have $14,000 receipts from sales from month 3. In month 5, $20,000. And in month 6, $28,000 receipts from the sales we made in month 5. So the next line is common stock. Our entrepreneur set up a C Corp. So the money that he puts into the company is called common stock. If you set up an LLC or some other form, it might be called something else. It all depends on your legal entity. But in this case, a C Corp, the money the entrepreneur puts in is called common stock. So our entrepreneur looked at that income statement and saw those startup losses and decided that if he put in $8,000, it would cover the startup losses plus give him a little cushion to move forward. So he put in his savings of $8,000 in month 1.
Okay, now just to make sure I understand this, where this $8,000 came from is the entrepreneur did a rough estimate of what the costs are to start up his business, and he added it up, and that's where he got the $8,000 from.
That's right. So then we have disbursements. We have materials, and if you look at that materials line, we didn't use any materials in month 1 because we didn't have any sales, and this is showing you kind of directly how we're buying materials. So in month 2, or how we're paying for the materials. In month 2, we're paying for $5,000 worth, but that doesn't line up with our sales. So what's going on with materials? In order to understand that, Simon, we need to take a look at our little inventory chart down at the bottom of the screen.
Okay. Here we go.
So our supplier requires that we buy in minimum orders of 5,000 units. And our entrepreneur's inventory policy is to have enough materials on hand to cover next month's anticipated sales. So if you set up a little inventory chart for yourself, it will save you a lot of headache in keeping track of how this works, because there's almost nothing you buy that directly correlates with the number of items you sell. Even if you have a hot dog stand, you're going to buy a case of buns and a case of wieners, and they're not going to be the same number, and you're going to sell 25, but you've got 30 left over, and you need to learn how to keep up with that. So a simple inventory chart will help you to do that. So when you start out, you're always going to start with 0 in month 1. So we have 0 inventory to begin with, and we didn't ship anything in month 1, so we have 0 shipped. But we received $5,000 worth because we're covering next month's sales and ordering in increments of 5,000. So we have an ending inventory of 5,000. We didn't have to write a check because we also get terms of net 30 days with our supplier. So our ending inventory of 5,000 becomes the beginning inventory in month 2. We shipped 3,000 units and received another 5,000, giving us an ending inventory of 7,000 units. And we wrote a check for $5,000 to cover what we received in month 1. So that bottom line there of 5,000, 5,000, 10,000, and so forth is the number that appears on your cash flow statement for inventory, because that's when you're writing the check. So ending inventory of 7,000 in month 2 becomes beginning inventory of 7,000 in month 3. We shipped 7,000, received 10,000, and had an ending inventory of 10,000 and wrote a check for $5,000 to cover what we received in the previous month. The 10,000 ending inventory becomes beginning inventory of 10,000. We shipped 10,000, we received 15,000 with an ending inventory of 15,000 in month 4, and we wrote a check for $10,000 to cover what we received in month 3. So 15,000 ending inventory in month 4 becomes beginning inventory in month 5. We shipped 14,000, we received 20,000, and we have an ending inventory of 21,000 units, and we wrote a check for 15,000 to cover what we got in the previous month. 21,000 ending inventory in month 5 becomes 21,000 beginning inventory in month 6. We shipped 20,000 units. We received another 25,000, giving us an ending inventory of 26,000 units, and we wrote a check for $20,000 to cover what we received in month 5. So now you can take that bottom line and paste it into your inventory line in the cash flow statement, and you'll understand where that number is coming from and why it's different from your income statement number. All right, so the next line on disbursements is labor, and that's our Busy Fingers Assembly Company, and we pay them in the month that the work is done. They're contract labor, so there are no payroll taxes. So we have 0 in month 1, $600 in month 2, $1,400 in month 3, $2,000 in month 4, $2,800 in month 5, and $4,000 in month 6. And then overhead, Jimmy with the Jeep, 0 in month 1, and then $100 for the next 3 months. And then month 5, we go up to $200 because our sales are increasing. He has to make more trips, and then $200 in month 6.
Hey, Pat, why is it that we pay overhead in the month?
Because Jimmy needs gas for the Jeep. He wants to roll on the weekend, Simon.
Oh, okay. So Jimmy doesn't want to be paid next month. He wants to be paid on the month that he actually provides the service.
That's right. And we want to keep Jimmy happy, so he keeps that Jeep rolling. So our next line is salaries, and it's kind of the same thing. You know, it's a funny thing about employees. They want to be paid when they do the work. So salaries, again, 0 in month 1. The entrepreneur pays himself $2,500 in month 2, and then as he adds part-time help, salaries becomes $3,500, and then $5,000 in months 4, 5, and 6. And then rent, that landlord wants that rent check on the first of the month, every month, and no excuses. So rent is $800 a month all the way across months 1 through 6. And then we have a rent deposit, though. That number didn't appear on the income statement, Simon, but the landlord requires that we put 1 month's deposit down in case we damage the property or whatever, and that's not used up on the income statement. So it's just as if you put it on a shelf somewhere and you're making an assumption that it's going to be there when you vacate the lease. So $800, you write a check in month 1. And then we have insurance. On the income statement, we showed how we were using that insurance up at about $160 a month, but our entrepreneur paid for a whole year's worth of insurance in month 1. So he wrote a check for $1,920. Then that office equipment on the income statement, Simon, we were depreciating that, but on the cash flow, we bought $6,000 worth of equipment in month 1 and paid for it in month 2. We put it on the company credit card and the bill came and we paid it the second month. So then in month 3, we added another $1,200 worth of equipment as we added those part-time employees, and we paid that amount off in month 4. And then we didn't buy any more equipment for the rest of that period. Then office supplies, again, we bought a small amount of random office supplies and we expensed them on the income statement and we paid for them in month 1. Cash down at the office supply house. Advertising, Eon, our ad man, we paid him $400 in month 1, $600 in month 2, $1,000 in month 3, $14 in month 4. But then we have $0 in month 5. Our friendly advertising man, Eon, has terms that if you're a good customer and you pay on time for the first 4 months, in month 5, he starts giving you terms of net 30 days. So we're not making a payment to Eon in month 5, but in month 6, we're going to write a check for the $2,400 worth of advertising we got in month 5. And then the next line is brochures. The income statement, we were using those brochures up at a pretty even rate of $100 a month, but we bought $600 worth of brochures in month 1 and paid for them in month 2. And then income tax, we have zeros all the way across because entrepreneurs typically pay income taxes quarterly. So that income tax amount that we became liable for in month 6, we won't pay until the following quarter, which would be month 7 and is off of our chart. So we're not writing a check to the IRS in this 6-month period. And now we can look at total dispersed. So we had $4,040 in month 1, $16,200 in month 2, $11,800 in month 3, $20,500 in month 4, $23,800 in month 5, and $32,400 in month 6.
Matt, wow, this is really good to see how you build this up from scratch. And again, one of the things that I guess an entrepreneur needs to understand with a cash flow statement is, number 1, it actually tracks how much cash you're receiving or dispersing versus the income statement, which is how you are using up the actual item in your income statement. So that seems to be a really, really important lesson. And then the other important lessons, like what we talked about earlier, is the payment terms, right? How soon you pay your vendors as well as how your vendors pay you. So I think those are really, really key lessons coming out of the cash flow statement that you just built for us.
That's right. And the dynamic between the income and cash flow statement are very different, but very interrelated and very important to understand, as we'll see when we go down to our cash balances. So in month 1, we had a positive cash flow of $3,960. And with our beginning balance of 0, we had an ending balance of $3,960. So we always start our year 1 cash flow statement with a beginning balance of 0. Then we put money in and we write checks. So that's how we always have that. And then in subsequent years, you'll have the ending balance from the year before becomes your beginning balance from that. So the ending balance of month 1, $3,960 is our beginning balance in month 2, but we had a negative cash flow of $16,200 already. That gives us a negative ending balance of $12,240. So Simon, we need to stop right there, because that means business if you can't cover it.
Pat, I think we just got a phone call from our banker.
That's right. Our suddenly not so friendly banker says, Mr. Entrepreneur or Ms. Entrepreneur, when can I expect you down here to cover this shortfall? And you better say right away, ma'am, or right away, sir, or else, you know, if you're truly out of money, that's when the big padlock comes out and they lock your shop down and you're done. So you don't want that to happen. And we have to look at this too and recognize that our entrepreneur put in $8,000. So we'd have to add that in there and factor how much money we're really going through here. Our burn rate is pretty high for this little widget company. So our ending balance in month 2 becomes the beginning balance in month 3. We have, again, a negative cash flow of $5,800, and our ending balance is getting in a bigger hole. Month 3, we have an ending negative balance of $18,040, and that becomes our beginning balance the following month. Again, we had a negative cash flow of $6,500, and that gives us an ending balance, even bigger hole still, of $24,540 negative. And that becomes our beginning balance, $24,540 negative, with an additional cash flow deficit of $3,800. And now we have an ending negative cash balance of $28,340, which becomes our beginning negative balance month 6. And we add $4,400 negative cash flow. And our final big hole by the end of month 6 is $32,740 negative. And Simon, remember, we have to add in that $8,000 that the entrepreneur put in, and he thought that was going to cover those startup losses and be enough to give him a cushion. But we see that what he really needed was $40,740 or something plus a cushion. So he really probably needs at least $45,000 to start this business.
Pat, I am stunned by looking at these numbers, because what you're basically telling me is that the entrepreneur underestimated the required capital to start his company by almost $33,000. Right. And that's crazy.
It is, and you can't go to the banker at that point and ask for a loan, or to your investor and ask for more money, because they'll think you are a pretty poor planner if you didn't understand that before you jumped into this thing. So the way we really want you to do this, to get the clear picture for your business, is to run your numbers without any paid-in capital or any common stock, and then see what your biggest deficit is. And you'd have to run it out probably longer than 6 months, because we've still got pretty big negatives there. So you have to see where your maximum deficit is and then add a cushion. And now you've got a much better number to start with.
Well, that was really, really helpful, Pat, for us to understand the cash flow statement and how the cash flow statement works. And by the way, there's also a distinction between cash flow and ending cash balance. And so those are two concepts that I think the entrepreneur needs to better understand as well. And of course, our banker cares about the ending cash balance.
That's right. So now, Simon, we want to ask everyone to think about, if these were your numbers and you saw that our little widget company, Inner City, which seemed like a simple little startup, was really going to take $45,000 to start, would you start this business?
Boy, that's a great question, because you look at these numbers and you basically say the company's bankrupt in month 2. But on the other hand, you know, when you do some market analysis, this seems like a concept that has a great upside. And so that's really a difficult question to answer, Pat.
So we're going to ask our students to ponder that for a while, and we will resume a little later and talk about it some more.